All right, let's see what we've got here. Looks like we have moved on to chapter 16, which focuses on job order costing, and we're going to have our first look at the application of factory overhead in a manufacturing environment, and that is going to be something new for you. So let's see specifically what we're going to do. Well, we're going to talk about the differences between job order costing, which is this chapter, and process costing, at least in general. That'll be next chapter for process costing. So we'll make some minor distinctions now. We're going to learn about something called the predetermined overhead rate and how we're going to use that to apply overhead to either goods manufactured or services produced. We'll be focusing mostly on items that are manufactured. We'll look at some source documents related to job order costing that are specific to job order costing. And then most importantly, perhaps, we really need to understand cost flows associated with job order costing. So, when we talk about job order costing, it says here that if a company's products, services are unique, they require a job order accounting system. And if, on the other hand, we're talking about products that are homogeneous, that are all the same, we're going to use process costing. So, even though we're going to be mostly talking about companies that manufacture goods, we see what appears to be the first page of a tax return. And so as we get older and our lives become more complicated and TurboTax just won't cut it anymore, we might need the help of a professional tax preparer, or if we're just petrified of doing taxes. And so, if we have if our life is simple, we can just use a free tax software, and TurboTax is basically the same thing as that, except that you have to pay for it. But that's really for tax returns that are simple and there's not much to them. Once we get involved in our lives, we tend to complicate things, so we may have to hire a CPA to do our taxes. But the CPA is going to charge for each of those tax returns based on time, how much time is spent, and what they have invested in those returns. So we can't just say, okay, well, we'll do your tax return for $500, because $500 would be a great deal for some people who have a complicated tax return for which TurboTax is just not going to cut it. But $500 might be too much for someone else, so we have to price these in a job order manner to reflect the level of difficulty for the individual tax returns. On the other hand, we go to the grocery store, we're looking here at 1, 2, 3, 4, 5, 6 bottles of ketchup. Well, we hope that it doesn't matter which one of these we pick. We expect it to taste the same regardless. So this would be process costing accounting systems that are making homogeneous products. So our focus for this chapter is over here on job order costing. So again, just as the tax return is customized to the customer based on the level of difficulty, when we're talking about anything related to job order production, these are built to order products. That's giving the impression that these items are all custom made. I don't know that that's necessarily true, but if we think about it, we've got some examples here. Furniture making, construction. These are all wonderful examples. Automobile repair. Not all automobile repairs are created equally. But it can even be something like making jeans. The job order we're going to make so many pairs of jeans that are of a certain width in the waist and then length in the leg. And so, we can't make all of the jeans the exact same. They'd only fit a few people. So these are all examples of job order costing. So here we go. We've got some basic differences here between the two. Wide variety of distinct products in job order costing. Process costing, well, we're making ketchup. Maybe we're making some other type of condiment that uses tomatoes, something like that, but large quantities of the same thing. So we want distinction here. We want absolutely no distinction over here. We want that ketchup to taste the same no matter which bottle we purchase. And then we've got some other characteristics, job order costing. We're going to accumulate cost per job. So I give you the blue jean example, and let's just say that we're going to make 1,000 pairs of jeans that are of a certain size. We're going to accumulate direct material costs, direct labor costs, and we're going to apply factory overhead based upon that run of 1,000 pairs of jeans at that specific size. And then our per unit cost is the total job cost for those 1,000 pairs of jeans divided by, in this case, 1,000, because that's our output, 1,000 pairs of jeans. All right, I'm going to skip past this slide. There are two different types of costing that are available to us. We have what's referred to as actual costing and normal costing. And in actual costing, we're going to use the actual costs of direct materials, direct labor, and overhead to determine unit cost. Now, normal costing is almost the same, or at least it's 2/3 the same. In normal costing, we're going to use direct materials, direct labor, but we're going to apply overhead based on what we estimate overhead to be for the entire year, and then we're going to come up with a formula to do that. So if we look at this, you might say, well, clearly actual costing is the best, but that's not actually the case. When we have actual costing, we have some issues with it. And the biggest issue, there's a lot of information on our slide here, but we have two, and they both deal with the same word, uneven overhead cost, that are not incurred uniformly throughout the year, and then also uneven production schedules. And this is, to me, this is probably the biggest thing, or probably the easiest thing to relate to. If we're going to use, actual materials and actual labor, that's fine. But if we use actual overhead, if you recall our discussion from the previous chapter, a lot of these costs that we're incurring are of a fixed variety. And so what happens is, if we use actual costing, what's going to happen is that in periods where our production drops, okay, but our fixed costs remain the same, our per unit product costs are going to be extremely high, and we're going to have a product that we're overpricing and is difficult to sell because that low volume of output is absorbing all of those fixed costs. All right. And then conversely, in periods of time when our output is really, really high, well, the fixed costs are the same. So the fixed costs become less and less of each unit, and so we underprice our items, and that's a problem. So we actually are going to use normal costing. That's what is going to be approved, and this is, it says here, virtually all firms use normal costing. So again, we've said this already, but using normal costing, we're going to determine product cost by adding actual direct materials. We do that in actual costing as well. Actual direct labor, that's another similarity, and estimated overhead. And we are going to tie all of this out at the end of the year. But what this does is by using estimated overhead with a predetermined rate that we're going to learn about a little bit later, we're able to avoid those types of problems, specifically and mostly with uneven production throughout the year. So, part of this course is to teach you how to make decisions. And I'm a firm believer that if we're going to be able to make decisions, we need to understand the importance of establishing true cost per unit, and in total. For the cost in total is pretty easy, but there are a lot of implications for per unit cost. Every time we sell a unit of production, we have revenue on the income statement, but we also have balance sheet implications as far as, unit costs are essential for valuing inventory. So whatever direct materials, direct labor, and factory overhead that we apply to a product, that is initially going to show up on the balance sheet as an asset, and specifically a current asset. And then when we sell each one of these units, we're going to have a major expense over on the income statement via cost of goods sold. So the more accurately we can estimate overhead with a formula, the more efficient we're going to be, and the better a job we're going to do for our managers and for our marketing people who are trying to sell whatever product it is that we have. So this is this is something that it should not be taken lightly. It says in the long run, for any product to be viable, its price must cover its full cost. So we want to make sure that we're not selling our product for not enough money. This is one of the things that we avoid when we don't use actual costing. But also the other side of that is true. We want to make sure that if we're aiming for a certain target profit margin, that our profit margin is not really above that by too much, because then we become uncompetitive in the market and it's difficult to sell our product. The same thing is true in service firms. It's a little bit easier because we don't have direct materials when it comes to service firms. But, they give the example here of a hospital, and, clearly somebody who goes into the hospital could have any variety of reasons for being in the hospital. And we saw on a previous slide, we saw the example of tax returns, and we also saw the example of automobile repairs. And we also saw construction. We can't necessarily, these are all, now there's a lot of materials that are used in construction, so maybe that's not the best example for a service firm. But the point is that when we're off by just a little bit on our per unit cost, when we extrapolate that tendency out, it can cause us real problems. We're either overpriced and we're uncompetitive, or we're underpriced and we can sell a whole lot if we're underpriced, but we're going to be losing money hand over fist. So that's not good either. Okay, so that's kind of an introduction to job order costing and normal costing techniques, and we'll start getting into a little bit more detail in the upcoming videos.